Debt is no longer a fiscal obligation. It becomes the organizing principle of the budget. The crowding out math is hard to argue. With sovereign yields at 18 to 20%, bank capital would always chase risk-free paper over project lending. The government absorbed roughly 1 trillion monthly from the capital markets. The question is not whether Nigeria can borrow. We can. But it is whether borrowing at this scale leaves sufficient oxygen for private investment, job creation, and a productive economy that should be generating the tax revenues to reduce future deficit. The central bank governor has provided a context for this. He has warned that the fiscal space for pre-election spending is non-existent. The 2026 budget carries a 70% deficit to revenue ratio, and a proposed 189 billion naira asset sale represent less than 1% of total budget financing, raising the question of whether this is genuine asset financialization or a balance sheet fire sale. That said, there are constructive paths forward. Institutions like InfraCredit offer a mechanism to redirect domestic capital towards infrastructure by de-risking long-term debt for pension funds and institutional investors. But the missing pieces remain bankable project pipelines and credible off-taker structures at scale. One of those issues Dr. Teriba has advocated on in creating what she calls a national investor deal book. Nigeria's fiscal challenge is not a question of capacity. It is a question of choice. And that choice must now be made intelligently. Our distinguished panel is here to help us make sense of these choices. I look forward to the deliberations. Thank you. Over to you, Otto.
Very insightful remarks from Chairman of Proshare. Thank you for setting the pace for the conversation. One very clear thing that's been raised is that the government absorbs roughly 1 trillion naira monthly from the capital markets. The question is not whether Nigeria can borrow, but whether borrowing at this scale leaves sufficient oxygen for private investments, job creation, and the productive economy that should be generating the tax revenues to reduce future deficits. Another major issue highlighted is that there are constructive paths forward. And we have an example of the InfraCredit that offers a mechanism to redirect domestic capital towards infrastructure by de-risking long-term debts for pensions and institutional investors. Very incisive opening remarks. And of course, we look forward to the conversations for today. I know our great audience are eager for the conversation proper, but I would like to invite us again to participate in the second poll for the conference. Thank you.
Yeah. I don't click, the thing don't go.
Thank you. Thank you for participating.
It's back.
I would now like to welcome our esteemed speakers for this edition of the Proshare Economist Conference. Mrs. Sanyade Okoli, the Special Advisor to the President on Finance and Economy. Mr. Johnson Chukwu, Group Chief Executive Officer, Cowry Asset Management. Professor Francis Obafemi, an economist in the Department of Economics, University of Calabar. And Mrs. Ibukun Oyedeji, Group Chief Financial Officer, Access Bank PLC. We also have special guest appearance, and this is a unique one, from Dr. Ayo Teriba, an economist and CEO, Economic Associate, and Dr. Tilewa Adebajo, CEO, the CFG Advisory. It's great to have you all for this conversation. And so we'll begin our first phase of the conversation. And just to notify our audience that the speakers will be addressing the following objectives of this conference, which include examining Nigeria's debt trajectory and fiscal financing strategy, assessing whether rising sovereign borrowing is crowding out private investment, evaluating the monetary fiscal policy mix and interest rate signaling, interrogating asset monetization as a sustainable alternative to debt-dependent funding, identifying investment strategies in a high-rate, high-risk environment, and offering actionable policy and market recommendations for 2026 to 2028. I like the last part. So I'll begin with our first phase of conversation, and that will be with the scholar and economist, Professor Obafemi. From a structural economic perspective, What specific non-negotiable fiscal reforms must the government implement immediately to break the cycle of deficit finance consumption and redirect domestic borrowing towards genuine growth, enhancing investments?
Yeah, thank you so much, Proshare, for having me in this program. And thank you for the question. Good morning, everybody. Before I give my answer to that question, or my thoughts, not really answer because I'm not in an examination, my thoughts on the question, when I looked at the topic and what we're about to discuss, the question I asked myself, though I don't know the thoughts of others, is what really are we going to be saying that is different from what we have been saying in the past 40, 50 years about Nigeria borrowing debt rates? And with that political will to implement some of these things, because Nigeria is not bereft of ideas. I think most of the time our problem is with implementation. Having said that, looking at that question, I want to say that when we talk about structural perspective, we have to know, remember that we are not talking about the market mechanism. Government has to come in. We are talking about reforms that will involve governments. And that was why I started from where I started, that would there be political will to do some of these things. Now, we have earlier said by the chairman, he has said that borrowing is not Nigeria's problem. And nobody will say we should not borrow. The question had always been, what are we borrowing for? What are we borrowing? How do we use this money borrowed? And when we talk about reforms, I think that Nigeria should be restructuring our expenditure. I put it a kind of expenditure switching and borrowing switches. I call it switches, though it's restructuring. What do I mean by that? We should stop borrowing for consumption. There should be an act of law dictating our borrowing. We shouldn't just borrow. We can't be borrowing money to pay salaries. We can't be borrowing money to run elections. We can't be borrowing money for things that does not promote production or enhance production. So the first thing is that we should be able to restructure our expenditure. What we borrow for? What are we really borrowing for? So we should borrow for things that will encourage production. So the government, in borrowing to fill up the deficit, should be able to borrow for things that will generate, that will help Nigeria, so that in the long term, they'll be able to pay off without so much relying on the future suffering. Then the next thing, apart from this expenditure, because of the timing, is this what I call borrowing switching. Now, if we look at the country at the moment, most of the fiscal space, most of the funds are being taken up by the government. The government is aggressively looking for money to fund these deficits. And the banks, being who they are profit maximizing firms, will prefer that. So there should be a kind of borrowing switch. What I mean by this is that the banks themselves who are borrowing should be made to look at the private sector. You know, when I looked at this, I thought about this thing. Each time I'm going on the road, I saw sukuk. Is it not what they call it? Yes, sukuk. Sukuk is an example of what we should be making our banks to do. They should borrow, they should finance investments that will help production. Capital goods, yes, we know they are looking for profits. But this, idea of just lending to government because of the yields is not going to help Nigeria. It's not going to help Nigeria. So we must restructure the way banks, either by law, so they are for profit making, or however, so that the bank should also look at the private sector, not allowing the whole funds in the domestic space to be taken over by the large chunk to be taken over by the government. It will not help us. And then again, I think that in this issue, we should learn to cut down on extra budgetary expenditures. Nigeria should cut down. We have made our budgets. Can we stick to these budgets? Can we stick to, smarter here, oh, supplementary budget for this, supplementary budget for that? It's not going to help us. It's not going to help us. I think the government should find a way to stick to the budget we have made. If we can stick to our budget, it will help us. We will have growth. And also, some MDAs, they had been an agreement that CBN will know nobody sees what they're doing. They are just there doing the NNPC. Nobody sees what they're doing. Everybody should be captured in the budgets. In effect, is that Nigeria deficit financing that will enhance growth. We should look at our expenditure. We should not borrow and spend on importing food items, paying salaries, recurrent expenditure.
Thank you
said that at times, I was reading something. Recurrent expenditure, yes?
Yeah. Thank you, Prof.
Hello.
Yeah, Prof, you've made very clear points. And I know we'll get back to you. You've said that we need to restructure expenditure. We need to stop borrowing for consumption and look at the act of law that strengthens that. And expenditure should be tied to productivity. And also, you've mentioned Sukuk as a very good example of ring-fence financing. So very, very good opening points made by you. And of course, we'll get other perspectives. And of course, in our next phase, you will get further insights from you. Thank you very much.
Mr. Moderator.
Yes,
sir.
Yes, sir.
Can I raise a point of order?
Okay,
if we have Mrs. Sanyade Okoli in our midst, and we are discussing government budget, government debt, government finances, I thought you should give us the privilege. It's quite a privilege to have her in our midst if she's there. You should give us the privilege to hear from her. Let her put the issues on the table.
Yeah,
so that we are not we can't be having academic discussion when we can hear from the horse's mouth. Just a point of suggestion.
Yeah. Thank you very much, Doctor.
Thank you.
Of course, Mrs. Okoli is next in line for the conversation.
Apologies.
Mrs. Okoli. No problem, Doctor. It's nice. It makes the conversation very interesting. And of course, this is what we always encourage, very robust conversation. So, Mrs. Okoli, nice to have you on the conference. As an advisor to the government, how do you respond to the private sector's concern that the current scale of domestic borrowing is not just crowding them out of the debt market, but actively starving SMEs and corporates of necessary credits? What is the administration's plan to ensure its borrowing does not suffocate the real economy? I can also respond to some other issues raised within 3 minutes. Thank you very much.
Okay, good morning, everyone, and thank you very much to Proshare for inviting me for what is clearly an important and also timely conversation. And I'm going to step back, 3 minutes short, but I'm going to step back because Dr. Tereba touched on an important issue. I think it's important that we situate the budget and the borrowing and everything within certain contexts. We've got to remember where we're coming from when 2.5, almost 3 years ago, this government came in. There were so many distortions in our economy that nobody was going to invest. And it also had significant instability. For example, you all know about the FX liquidity. So the first effort was really about addressing those distortions. But we also know the effect that had, significant depreciation of the naira, high inflation, etc. And so the second effort really was trying to bring some level of stability. But where are we going with all of this? The singular focus of this government is to drive economic growth that is inclusive, that is sustainable, and that lifts people out of poverty. But as you can imagine, from where we're coming from, this is not a simple or an easy task. This is something where at various points, we will have to sail the fine line, there will be trade-offs, etc. So speaking specifically to the issue, right now, in terms of borrowing, of course, we're trying to, the idea of the budget is one that will stimulate economic activity, where it is not just borrowing to cover recurring costs, etc., but it's borrowing to ensure that we can also invest in catalytic area, because to get the kind of growth we're talking about, we need to attract investment. To be able to attract that investment, we as government need to also make catalytic spend. And really, yes, we've heard the concerns about government crowding out the private sector. And it is something that we too are mindful of. As you know, the debt management office, this is something they look at very carefully. And to remember that government's borrowing is not just from the Nigerian capital markets. For example, at the end of last year, we had a very successful Eurobond issuance. So it's the idea is not to seek to borrow that entire amount from the Nigerian market. But I think another thing we need to bear in mind is for us to have an economy that grows, there's a level of macroeconomic stability that is required. And one of the key aspects is bringing down inflation. And as we know, the central bank has been using interest rates as a tool to bring down inflation. And so therefore, the rates at which government is issuing, but also the rates at which corporates are borrowing, is of course informed by the inflation rate and the interest rate. I'm conscious that I've gone over time, so I will pause there.
All right, thank you very much, Mrs. Okoli. You reminded us that government has a role to play in driving economic growth that is inclusive, provides jobs and lifts millions out of poverty. And you've explained around government borrowing and the dynamics. But of course, this conversation will be broadened in our next round when you respond to some of the issues raised. But thank you for laying the premise from the government perspective. For systematic, important financial institution, at what point does the concentration of bank assets in government securities shift from being a prudent liquidity management strategy to a systemic risk that jeopardizes the core function of financial intermediation? What balance sheet metrics should we watch as a major warning signs at this time? That's for Mrs. Oyedeji. Okay, while we expect Mr. Oyedeji, yes, okay. While we expect Mr. Oyedeji, who supposed to join us, but said she had an urgent meeting, but we expect I'll move quickly to the domestic debt market approaching its absorptive limits. Are we simply financing today's deficit by creating a massive high-yield rollover risk for tomorrow?
What's up, is that for me?
Yes. Let me retake it again. As a market operator, you see the order books firsthand. Is the domestic debt market approaching its absorptive limits? Are we simply financing today's deficit by creating a massive high-yield rollover risk for tomorrow?
Well, I wouldn't say we are creating an unsustainable high rollover risk for tomorrow, because if you look at the yield curve, you'll see we have an inverted yield curve environment, which projects or portends that in the future, the rates will come down. And so if that be the case, so investors are saying, look, I can go long because I expect at the point of rollover, I will be able to get that high rate I'm getting today. So if you look at the yield curve, one would say the opposite is the case. But that does not in any way diminish the fact that our current debt profile, particularly our debt service obligations, are looking indicative of something if we considering this trajectory to become unsustainable. If you look at current debt profile of about $47 billion, debt service for this year is projected about 15.5 trillion naira. And bear in mind that the government is only projecting an income revenue of about 34 trillion naira at the federal level. That is the federal government projected revenue about 34 trillion, which on some of the parameters even look unrealistic. At the same time, the government wants to borrow 15.5 trillion naira from the local market, in addition to about 3.6 trillion naira from the foreign market, which I think if you look at what Mrs. Okoli said, that we need to fund, and we're not just borrowing locally. We're actually predominantly borrowing locally. We are only 15.5 trillion, which will be added to the existing local and currency debt. The implication is that debt service will further balloon. And as it stands today, if you talk of a 34 trillion naira budgeted government revenue and the 15.5 trillion naira debt service, you're almost talking of close to 50% of total government revenue that will be consumed by debt service. So that is frightening. And because we're going to add additional debt liability to the existing $47 billion, so it then means your debt service will further increase. So what I'm saying is, in as much as you are saying, look, the outlook on interest rate environment is that interest rate will moderate. So because if you look at the yield curve, so that is indicative that interest rates will moderate. But that does not diminish the fact that the debt service is getting to a level that will be difficult to sustain because it's crowding out investment in critical sectors of the economy. Government budgeted for this year about 26 trillion naira for capital expenditure. Of that amount, just barely 1.5 trillion naira will come from revenue, assuming the government achieves a revenue projection, which I think is overly optimistic. So we are dealing with a burden debt crisis. It is not yet crystallized, but we must be conscious of that fact that we continue in this trajectory, we're going to have a refinancing difficulties, not necessarily because of interest costs, but because the volume of the debt obligation liability will be so that even when you refinance it, the cost of refinancing it will almost completely erode government revenue as it stands today.
Very, 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 very deep thoughts shared by Mr. Johnson Chukwu. The need, again, to look at our debt service level, which, of course, you said we must guide against a level where it's unsustainable. And, of course, the challenges of real financing at this time, and the need to look at the fact that the volume of debt obligations and the cost of refinancing remains that challenge. So there has to be that balance. And though the interest rate is moderating, these are the challenges we are facing. And of course, this is why we have this conversation to chart a path forward. I just want to confirm if Mrs. Ibukun Oyedeji has been able to join. Mrs. Ibukun Oyedeji, are you online? Okay, so we'll still expect her. Now we would take special permission. One of our guests for this conversation has taken permission because of an urgent meeting he has. So we would allow him before a second round of conversation to just give his remarks. And that is Dr. Tilewa Adebajo. He's the CEO of the CFG Advisory. Dr. Tilewa, we'll just allow you to give your remarks for this conversation, your thoughts, which is very valued, for the next 4 minutes. Thank you. We'll yield the floor for you.
Please let me yield the floor to Dr. Teriba first, and then I'll come after him.
No, in terms of the conversation, we've programmed that doctor would speak in our next round of conversation. But since you know that you have an urgent meeting, we'll
yes,
just
I still have some time. I still have some time. So
okay, no problem.
Okay, so that's why I said let me yield the floor to him because I'm not on the schedule. So let him.
I'm happy to do that, Tilly.
Yes, please. Okay. I'll come after you.
Thank you. If the moderator permits.
Okay, then. So since Dr. Tilewa has yielded, of course.
I'm happy to do that. I'm happy to go before Tilly.
Okay.
Thank you very much.
Okay.
Good morning, everyone. And I'd like to congratulate Proshare for making this once again very unique. The last time we had 2 female speakers and 2 male speakers. You've pulled it off today. You planned 3 female speakers, and of course, 3 male speakers. And I'd like to welcome especially Mrs. Sanyade Okoli, the special advisor to the President of Finance. I hope I get it right. Economy and finance, yes.
Yes.
We've been looking forward to having you for long, so you're welcome. And I'm happy to have Prof with us too, and of course, Chairman Chukwu. Tilly, it's always a pleasure. Let me quickly respond to Mrs. Okoli. I have about 3 statements to make to you, brief ones, since I have only 3 minutes left. And I still like to, say something about what Mr. Chukwu has said. Mrs. Okoli, I want to congratulate your administration for successfully putting an end to ways and means financing, for securitizing ways and means, and for not going back to it. I commend the president especially for that discipline, that whatever the pressures are, ways and means is a thing, abusing ways and means is a thing of the past. Then it's the only or the sole means of deficit financing ought not to be. You have a very buoyant capital market supported by government. And, you just issue debt alone, you never issue anything in the and it's a problem. Because the money you are borrowing is for, most of them are for state-owned enterprises, including NNPC. Name them. We just forgave, the same NNPC, about 5 trillion in a year when we struggled to get 25% of the 40 trillion we planned to get. Put all these state-owned companies in the stock market and let them borrow in their own name. Let them struggle to raise revenue and service their debt. So you borrow on their behalf. So the beneficiaries of the debt that government is raising are faceless. You just send requests to the National Assembly. The National Assembly raises it. We don't know who gets it. Put an end to that. Let them come and borrow in their own name. Let them repay in their own name. Let their risk be rated. And you can only do that if you list them. There's no reason, why you should say NNPC is now private and government is still borrowing for NNPC. So basically, I've made 3 points. Thank you for not going back to ways and means. But please do equity as well. And when you do equity, the debt you have to issue. Because once these companies are in the stock market, it's no longer government debt. And if anybody is not going to borrow this year, in a year when already, if you look at year-to-date increase in market capitalization, there's liquidity in the market. And there'll be liquidity because the Naira is appreciating. Everybody is exiting dollar position to get into Naira position, and you can either own Naira cash, or Naira deposit, or Naira bonds, or Naira equity. And if you look at what government has issued, it's a joke compared with the issuance that happened in the stock market in 2 months, if you take February as a month. So please, raise money from the market, but not from that market. Raise from equity market. And you would have offloaded, I don't know the number of SOEs you have. That's my, Then Mr. Chukwu, this is a year that I've predicted that 2026 will be a repeat of 2006. It's also a pre-election year. 2026, 2027 will be a repeat of 2006, 2000. It was the only time in previous history that the Naira appreciated. And issuance across all liquidity market segments multiplied. So I'm expecting the stock market to at least double this year and maybe triple next year, in spite of election, as it did in 2006, 2007. And if you don't issue debt now that interest rates, Mr. Chukwu has said yield curve is inverted, that tells you interest rates are going to come down. So government can double its debt issuance, and its debt service will be 1/4 of what it was previously. So please, nobody should discourage government from issuing equity so you can enjoy capital gains as well, like the global leading firms, tech companies are doing. They are gaining more from their market value multiplying than they are gaining from their income statements. Income statements are stagnant, balance sheets. So issue equity, and when the shares of those companies you put on the market are multiplying, they can borrow money and repay, just like the global tech companies. And the companies that are lucky to be in the stock market at this time are doing and will do. So basically, to Mr. Chukwu, I'm saying inverted yield curve means that if you can borrow, because your debt cost will go to 1/4 in a year of a single inflation, a single digit inflation, and likely single digit interest rate before we end when we end the year. But issue equity first, and then borrow money, and you can easily sell, buy back your, sell your shares to service your debt. Will be my own opening statement. I hope Tilly, can take the floor now. Thank you very much.
Thank you very much, Doctor. Of course, we know you are a strong advocate of financialization. You have advocated again that government should leverage equity financing, and you've reminded us that 2026 is reminiscent of what happened in 2006, where the market was really on a high pedestal. So,
and if I may quickly add, Ibukun is not here. I hope she joins us. Yes, before we start talking about the exposure of banks to government debt, let's talk about the exposure of banks to central bank in cash reserves that has been sterilized. What fraction of their balance sheet is locked up, of no use to the banks, of no use to government? I leave it there. Thank you.
Chukwu is here. He will answer that.
Okay, thank you very much. Now, Dr. Tilewa Adebajo, over to you. Dr. Tilewa Adebajo, you have the floor now to make your remarks.
And yes, can you hear me?
We can hear you very well.
Can you hear me?
Yes, we can hear you.
Okay, well, first of all, the chairman of Proshare, my very good friend, my dear friend, Mr. John Chukwu, Sanyade, Prof, and of course, Dr. Teriba, and our moderator. Thank you very much for this invitation. I want to make my own comments very quickly and maybe listen more than comment, because as you know, I've engaged each one of you individually over the year, and which I constantly do in terms of my own advocacy. And a lot of what I say comes from interaction and contributions from my discussions with a lot of you. I just tend to have raised my concerns about what's going on, about the sustainability of debt. And I think what I also tell Sanyade is also that I'm concerned about the foreign debt that's being raised. Our foreign debt now is about $46 billion, and local debt is about 80 trillion. We shouldn't be borrowing money in dollars to bring back to Naira to fund our operations. It's completely wrong. If we're looking to have any offshore obligation, because again, I don't even know the revenue profiles anymore. How much is coming in from NNPC? How much is NNPC remitting? But luckily, we have reserves of close to $50 billion now, which shows a significant level of stability, and the central bank governor says net reserves are in excess of $30 billion, which at a point in time was less than $1 billion at the height of the takeover of this government, when this administration moved from the Buhari to the Tinubu era. The way the reform was handled was not the best, and the central bank governor was not appointed on time. The finance minister was not appointed on time, and you made announcements which kind of unsettled the market. And before we realized what was happening, another 7 trillion in ways and means financing had gone. So my concern really is the fact that let us understand the balance sheet of the government. Again, the problem we have is that the debt figures we have is still at June. I don't know why the Debt Management Office cannot release up-to-date debt figures, because I mean, we know we can figure it out. We can extrapolate and understand the borrowing pattern. For instance, the Debt Management Office has announced they're going to borrow 800 billion this February. So we know that their run rate is about 1 trillion a month, which is the capacity from the local domestic markets. But having said that, what I will tell you is the fact that we all know that if we took the balance sheet of the federal government of Nigeria and removed its name and took it before any credit committee of any bank, they wouldn't give them any money because of the leverage. The numbers are completely out of whack. And it's only because it's a sovereign that we're looking at it. If you're going to give 15.6 trillion naira to the banks every year, it's a good place to be. They are not complaining because both the international banks and are going to be, and the local banks are going to benefit. And of course, we need to maintain our Eurobond ratings and rankings, and I agree with all that. But we need to take a critical look, because we don't see where all this funding is going to. It's the impact for me that is the issue. I think Mr. Tereba will understand that the reason why we have the CRR is to lower inflation. And I think we all know that we're going to, disinflation has been one of the successes that has been achieved for these reforms. And hopefully this year, we should get to single-digit inflation. We all know that. And I think there's still a disparity between the rates that government is borrowing at 22% and the NPR at 27%. So hopefully there will be some corrections from the next MPC meetings by reducing the NPR. But having said that, my own contribution is just to say that we have a challenge, and we shouldn't take these challenges lightly, because it can ferment a crisis if it's not properly managed. And the legislators that I engaged last week, their own attitude is to continue to spend and to find ways to spend that money. But again, like I've said, we need to look at other alternatives and engage private sector, public sector, private sector participation. What can you concession? Even if you cannot, there are very few state-owned enterprises that you can list at the moment. Most of them have been privatized. So the other ones that you can look at concessions, the ones you can privatization. Even the privatization in the budget is only 300 billion, less than 1%. So I thank you all for your contributions, and I continue to engage you individually. I understand Prof's concern about exactly where's the impact. So all this borrowing, where is it impacting? Where is it going? And to also answer Prof, we have a Fiscal Responsibility Act, and there's supposed to be a Fiscal Responsibility Commission to monitor a lot of government spending. But unfortunately, that commission has not been empowered. And I made a commitment to the Senate that after they've passed this budget, we should take a look at ways we can enhance the Fiscal Responsibility Act and bring it up to line with the current realities of the Nigerian economy. So I think that is my own contribution for now, and I think I'll just listen to what everybody else has to contribute going forward.
Thank you. Thank you very much, Dr. Tilewa Adebajo. You've raised very clear concerns and, of course, a pathway. You've acknowledged that the current reforms have brought disinflation, but, of course, you've raised the fiscal deficit challenge and, of course, the need for public-private partnership. And you also told, like Dr. Yoteriba, the need to concession to look at some viable enterprises to be listed, and also the need to spend on productivity. It's very critical at this time. And the last part, the Fiscal Responsibility Act, and the should be very strengthened, and that's very critical for this time. Thank you very much for your contributions, Dr. Yoteriba and Dr. Tilewa Adebajo. We'll now go to the second phase of conversations, and I believe our speakers have been refreshed by those remarks, and of course, we want to respond if they would like to. This second round will be going, each speaker responding in 3 minutes. Prof, you have been mentioned once or twice, and I believe that you will take it from here. We see a persistent and considerable gap between the monetary policy rate and actual market yields. What does this imply? A fundamental breakdown in policy transmission due to fiscal dominance, or is it a rational market response to a lack of credible signals? What can correct this? Over to you, Prof.
Thank you for that question, and I thank all the contributors. You see, we keep learning and unlearning. Though I'm here as a panelist, I also came to learn from the industry people. Now I'm in the classroom.
Yeah.
Now, when we look at what is going on in Nigeria, like I had earlier said, we are having a situation where government borrowing is almost crowding out private sector borrowing because of this aggressiveness on the parts of the government to fund the fiscal deficits. The yields, government yields, the yields to government bonds keeps increasing. In fact, I kept looking at them. I discussed with my husband, said, these yields are just going up, 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 up. And as it goes up, you don't expect banks or other investors who are rational, profit maximizers, to lend to the private sector for agriculture, for example, to lend to the private sector for anything that could be maybe for long term and all that. They will easily go to these government lower risk offers and put money there. So we see a situation where government yields, it keeps going up, and especially the banks and other investors, run there, crowding out the private sector. And the private sector, in trying not to be pushed away, struggling to survive their own yields, they will push it up. So what we are seeing is a situation where even the MPC will soon meet. They will soon meet. Even if they lower the interest rate, which everybody seems to be expecting that the interest MPR will be lowered, the private sector may not fare better because most of the domestic funds are taken over by the government because of their low yields. So what we see is not an issue of transmission. No. It's not an issue. It's not a failure in transmission. It's just the market behaving rationally because the market is rational. So that's where I'll put it. Thank you.
Thank you very much, Prof. The market is rational. They know what they are doing, and they're going where they'll get value. And so that brings that need again to look at what can be corrected. But thank you very much, Prof, for your insight. And Mrs. Okoli, we want to bring on board the recent developments around the 189 billion asset sale target, which sits within a 25.27 trillion naira deficit financing package. That's not even up to 1% of it. But can you clarify whether the Ministry of Finance Incorporated's asset optimization mandate has evolved into asset liquidation for immediate budget support? What prevents this from becoming politically discounted transactions rather than market price governance protected divestments? And lastly, where is the National Investor Deal Book that would detail asset classes, valuation methodology, and cash flow potential to establish capital market pricing rather than ministerial discretion? Ms. Okoli, over to you.
Thank you. So I have to join Prof in thanking all the other speakers for their contributions. And I said, this is a rich discussion sitting here as government. I didn't expect it to be easy, but we shall have these difficult discussions. A couple of points to make before I respond to your question.
Okay.
The whole question of debt sustainability, believe me, as much as all of us on this call and everybody listening, it is a concern to them. It is very much a concern to government. Not least, if you take the position, which obviously everybody is, that government is a significant borrower, then what is happening with the interest rate very much affects us from a fiscal standpoint. But then let me also remind everybody that where we were coming from was a position where our debt service to revenue was over 100%. And over the last couple of years, we have brought that down to 7%. So contrary to the position that we are moving to sort of greater depths of on sustainability, actually a lot of the work now is to bring it to greater levels of sustainability. But then this is not something that we can achieve in one day. This is something that will take time and will take concerted and intentional effort. So am I discounting the concerns? No, I'm not for 1 minute discounting the concerns, but all I'm saying on that is it is something that we're very much aware of and something that we are very much working on. Now, regarding MOFI, in the last couple of years, they've spent time going through and building their asset register. And you ask, where is that information? It is on their website. It is not hidden. There's a national asset register on the MOFI website that anybody can go register to get that information. And so they've essentially ascertained what government has. As you know, before MOFI, it was a department within the Ministry of Finance that was managing this. But now we have an institution that does that. And then they've also sought to categorize the assets, based on assessing the condition, both the physical and the financial condition of the assets, and put them into different categories. There are some assets where there's a view that actually just hold, do nothing. It's almost like, quote unquote, it ain't broke, don't fix it. That without doing much with it, you can continue to derive benefits. There are some others where there's that recognition that actually, to really optimize the value, we need to either invite private sector participation or divest it into the private sector, and Dr. Teriba spoke about it. For some, listing might be the best option. For others, it's actually, a smaller group of, financial stroke operational investors that can come to drive value, because essentially what you're trying to do, it's an asset optimization strategy to ensure that the government and, but more pertinently, Nigeria derives the maximum value from the assets that it has. I listened to the question of what's to stop Sanyade just doing side deals to get value from these assets. Well, the process that's being run, for example, with MOFI, I'm sure that you saw, that is seeking to partner with the likes of IFC in this asset optimization initiative. So this is not a few politicians doing back deals, but it really is about, it really is about how can Nigeria get the best from the assets that it holds. Thank you.
Thank you very much, Mrs. Okoli. You've said that we have a national asset register on MOFI website, which of course can be accessed, but of course we also expect to see that integrate into a national deal book, as we see in India, Brazil, where there are pipelines of projects and activities happening. Also, you've said, yes, that government is concerned about borrowing, but has done a lot to bring down those issues. And also the fact that MOFI is partnering with IFC. We need to track that and optimize. The most important thing is that we optimize the assets for Commonwealth to get value from it. Thank you for your response. I just want to confirm if Mr. Oyedeji has been able to join us for the next question. If not, we'll proceed with Mr. Johnson Chukwu. Mr. Oyedeji, are you online? All right, so we'll proceed with Mr. Johnson Chukwu. And Mr. Johnson Chukwu, you've heard several feedbacks and, of course, inputs from government, from scholars, and, of course, experts. But, of course, the Bureau of Public Enterprises has identified 91 federal assets for privatization, spanning oil and gas, power, transport, and even real estate. Now, from this perspective, and yet, of course, we have the 199 billion revenue targets, which suggests either severe undervaluation or limited transaction scope. So from an asset management perspective, Mr. Chukwu, what prevents Nigeria from structuring these holdings as diversified investment vehicles, like infrastructure REITs, transport concessions, energy utilities that generate recurring income rather than one-time cash? Is this a capacity constraint, a governance failure, or political economy resistance, having heard what Mrs. Okoli has just shared?
Okay, thank you once again, Atabasi. It's always a pleasure to be part of your session. I think I should have said that earlier, but it's better late than never. Back to Mrs. Okoli said, as it relates to what Dr. Tiriba said, that it may be good for the federal government to go to the market and raise money now that we have an inverted yield curve. Although he made reference to raising the equity, but the structure, which will take us back to the question you asked, the structure of federal government fiscal arrangement will make it difficult for us to raise equity immediately, because you have to put those instruments in such a way that people are co-investing with the federal government. So the federal government may not easily raise equity in a short time without the necessary structure being put in place. But what I'm actually interested in is the fact that it's in a period of inverted yield curve, it's time to raise, go to the market and raise money. I would rather differ from that. In a period of inverted yield curve, what you do is you stay at the short end of the market, because you expect that rates will come down in the near future, and then you can now go long when rates are low. If you think the outlook is that rates will come down, you don't want to go long and lock in on long-dated instruments at high yield. So the approach would be to stay in the short end of the market, sell short-dated instruments, so that by the time they mature, you would be able to refinance them with at lower rates when rates would have moderated. But that, now to what I wanted to mention on what Mr. Okoli said, I'm not aware that at any point in the history of this country, debt service had become more than 100% of government revenue. We were talking of debt service and debt recurrent expenditure, consuming more than 100% of Nigeria's federal government revenue, but not debt service alone. So we just needed to put that in context because we have a large audience here. Now, back to your question. What we're dealing with today is ability of the government to think through the entire fiscal environment and what are the opportunities available to them. The government trying to raise about 189 billion to partly fund the deficit of 23.5 trillion is a drop in the ocean. But having said that, the way they want to go about it, whether they should have put the right structure in place and do something like REITs, real estate investment trust, but then those federal government real estate assets are currently non-earning assets. So the first thing is to put them in earning form, which is why the most appropriate thing to do would be to go into commercial concessioning of some of these infrastructural assets. Take, for instance, the federal government, among the areas they want to raise money, is the airports, the road infrastructure, the road corridors, the rail corridors. The first thing we should have done is identify those corridors, those transport infrastructure corridors that are commercially viable, and then put an arrangement in place to concession them to private sector investors. Those private investors will pay a concession fee and then pay taxes to government. And then you create those corridors by giving them right of way, as well as giving them access to advertise and build motels and investment to invest capital into the economy, but will also catalyze other investments or encourage, make it cheaper for us to invest in the country. I mean, reduce the cost of production in the country, because if you have strong, efficient transport infrastructure, it goes towards reducing your cost of production within your economy and making your economy attractive as a destination for foreign direct investments. So we need to do that. But the other aspect of the infrastructure the government want to concession or want to sell, I think I also differ with the government some of the things they want to sell. There are structures we can put in place and make these assets longer, consistent earning resource or sources for the government, instead of, just like you said, liquidate an asset that is earning. Take, for instance, the concept that they want to sell down our holding in Nigerian liquefied natural gas. I completely do not think it's necessary, because that's one of the best investments the federal government has made. So why do you want to sell it down? It's like the concept of saying, look, I have a fowl that kind of lays egg, and then I say, okay, wow, this egg, I make so much money. Let me just open and take out all the eggs once and sell and become rich. Whereas if you open that, rather put them in structure that give us consistent earnings. The asset that you recommend for sale, the refineries, they are dead assets. Whatever we can get from them, let's sell them. I mentioned the issue of concessioning the transport infrastructure, the major highways, Lagos-Ibadan Express Road, Shagamu-Bini Express. These are highly commercially viable. Concession in the private sector, the rail corridors. There's nothing we have actually come up with a rail master plan, which has nobody has done anything about that. Some of those rail corridors are viable. If you have a rail corridor that runs from Lagos to Abuja, it will be viable. Anyone that runs from Lagos to Onitsha to Owerri to Aba will be viable. And private sector investors can invest in that. And let me just close by saying that we have a proof of concept, and I think the government need to learn from the experience that what we have done successfully. Nigeria was struggling to provide telephone services to its citizens a couple of years back. Maybe 25 years ago, it was said that we only had 445,000 active lines. Today, we have close to 200 million active lines. The government concessioned, granted licenses to telco companies who paid $285 million each. We raised over $1 billion in a single swoop. And then the infrastructure that we could have made not cut, viable infrastructure from budgetary allocation. We should have to involve a process to concession or hand over this, invite private sector investors to invest in this, free up government resources to focus on social infrastructure. Thank you.
Thank you very much, Mr. Johnson Chukwu. Very bold statements you've made, and of course, you want the fiscal structure to be reviewed in a way that encourages activities like financialization of assets and concessioning. You also made your position on the debt to service revenue, but most importantly, you've talked about the need to concession the rail and road infrastructure corridors, and also you said that we should not sell down our holdings in the Nigerian liquefied natural gas company, but we must learn from the telecoms experience, which of course is a good cause to boost private investments. Thank you very much, Mr. Johnson Chukwu. And we'll now move quickly to our third round of conversation. I believe that, of course, everyone is gaining some interesting perspectives as we go on. We've reached 1 hour, 3 minutes mark in the conversation. And of course, I believe that we're in some interesting times. So, Prof, I come back to you.
Oh, sorry, moderator.
Okay.
Don't leave us
Doctor,
out of this second round, please.
No, definitely.
If I and Tilly can also quickly chip in.
All right, definitely. We will chip you in after this. Yes, after this round, we'll chip you in because your inputs are very important. But let's first begin with Prof.
You don't want us to comment on this round?
Moderator. No, you comment. Yeah, after the speakers, we would bring in to comment, make your inputs. That's why we want to make it broad-based. Yeah, thank you very much, Doctor. So, Prof, the federal government, of course, this 189 billion conversation is very important. They want to realize that from state-owned asset sales, and that's just a drop in the ocean, like Mr. Johnson Chukwu has stated, out of 25.27 trillion naira deficit. But from a structural economic perspective, does asset-backed revenue represent a genuinely sustainable third pillar alongside taxation and debt, or is this merely fiscal gap plugging that liquidates the balance sheet without creating recurring yield? What institutional architecture would distinguish value-creating asset financialization from a fire sale? I yield to you, Prof.
Yeah, thank you so much, Otabasi, and thank you, everybody. Again, I want to thank Mr. Chukwu for his elaborate discussion. And I want to take it from there. He has really given he spoke my mind on most of the issues. And now, to be able to answer that question, we can't just say whether it is this or that, because first and foremost, we don't know what they're selling. It is when we know what they are selling, we can now say, okay, it is financialization or the other one. We don't know what they're selling. They only told us that, 91 assets and the areas where they're taking it from. So until we know, oh, they want to sell A or they want to sell B, we understand. And secondly, they've not told us the process. We don't know the process. Sorry. How transparent will this process be? We don't know. And if we know the process and what they are selling, we can say, yes, they are on the right track. Or no, they are not. Or on this, they are on that. Nigeria has gone through this before. We have gone through it before. And we all knew how it ended. The public, as we don't, the government, there is a trust deficit between the government and the public. There's a serious trust deficit. And if the government want to do this, they want to do it in such a way that people will believe them, that is, they really want to, not just to liquidate the balance sheet, then they must bring out a process that is very transparent, very transparent. So until we know what they are selling, until we know how they intend to do it, it may be difficult to say it is either this or that. But for example, if, like he said, like Mr. Chukwu has listed a whole lot of things that he feels that government should not sell. Now, for example, if the government tells us, oh, we want to sell the refineries, assuming the refineries are out of the things listed. Was it the other day, the NNPC limited, the GMD said that they have been wasting a lot of money, all the money they spent, how many a month, repairing that refinery, those refineries is a waste. That it could have been used in health, education, and all those things. If government wants to sell the refinery, for example, now, those refineries, I will turn my hat up. It will be an issue of financialization, provided that they did it transparently. So it depends on what they want to sell. So until we see what they want to, and their process. So to be able to do it in such a way that it will not just be mere filling a gap, a funding gap, or liquidating the balance sheet, I believe that they must be very transparent. The other one, the last time they did it, it looked more like the elites or the political class shared the assets amongst themselves, and people didn't really know much or what went underneath. So when this one came up again, if we listen to people talking, it's like they want to share our commonwealth again. So for government to have this confidence, will I call it confidence, people's trust in what they are doing, they must do it using the best international practices that get independent and the international benchmark for asset valuation. How do we value these assets? They must be able to, like Mr. Chukwu said, they must be able to know that some of these assets, you don't need to sell them. You only need to get them working properly, that will make money for us on the long run. It's just like a family. You have a house in a Broad Street, and you have a house maybe in your village, and you want to sell your house in the Broad Street, where we know that rent is high. So the government should be able to differentiate which one is which by using best practices to do the evaluation. And then secondly, there must be transparency. And the bids must be competitive. There must be transparency in what they are doing. People must know, not unlike before, that made people not to be very happy with what they did. And then secondly, there must be full disclosure of beneficial ownership. They must disclose who are the owners. Not the other one was a little opaque. People didn't really know. And then there must be public reporting of what is going on. You see, they must tell us this is our commonwealth. It's not anybody's own. If they want to sell anything, they should just realize that this thing is our commonwealth. It's not an individual's own. It's not a political party's own. It is owned by Nigerians, including me, including you. So we must know what the transactions, what they are doing. Let us know what they are doing. And then it must be insulated from politics. Let it not be used as a means of rewarding political loyalty. They must have the political will to do it transparently. So if they do all this, yes, we can say, and then be able to pick out the ones to sell and the ones we can still keep back for long term that can still generate revenue for Nigeria. It would have been a situation of finalization. Forgive me for my pronunciation, and not just fund gap filling. It's not just liquidating the balance sheet. So that's what I think. So we should know what they are doing and how they intend to do it before somebody can fully say, okay, this one is okay, this one is not okay.
All right, thank you very much.
I want to also add something to the former yields. Okay.
Okay.
Thank you.
Oh, Prof, you want to add something? Just 30 seconds. All right, Prof, maybe, the next phase, you will add it. But thank you very much, Prof.
Gap. Okay, I want just 30 seconds. This gap between the MPR and yields.
Yes.
Part of the major issue is this issue of fiscal and monetary policy non-coordination. It has been a very big issue. The monetary policy is going this way. Fiscal policy is going that way. In fact, during the time of Okonjo-Iweala and Sanusi, it was so obvious. So why the MPC will soon come and bring out an MPR, and the thing will not be responded. The private sector cannot respond, or the system, because of this physical dominance. So we should manage our liquidity and try to have a kind of a coordination between the fiscal authorities and the monetary authorities. I just wanted to add that. Thank you.
Thank you very much, Mr. Okoli. You've called for transparency and, of course, the process to be open and clear on how we want to unlock value from our assets.
That wasn't Mrs. Okoli. That was Professor Obafemi.
Oh, Professor. Okay, so sorry. Professor Obafemi. Yes. Thank you very much for your insights on this conversation. The process has to be very clear, transparent, and of course, we need to see that linkage between fiscal and monetary policy. Thank you very, very much. Thank you very much, Prof. So, Mr. Okoli, issues have been raised, but I'm going to ask you, and then you also respond to what has been raised by Prof. The recent Africa Good Opportunity Act renewal extension runs only to year-end 2026 with explicit America First reciprocity expectations, which we are now aware of. But given Nigeria's structural dependence on preferential trade assets rather than competitive export positioning, how does this narrow window affect the urgency of domestic revenue mobilization beyond taxation and debt? Does it reinforce the need for asset-backed funding models independent of external trade concessions?
Okay, so Otto, so far, I think you said 3 minutes for each speaker, and I think I've been the only person who's respected it. So I'm about to not respect it because there's a lot to be said. I think the first thing I want to say, and actually my fault because I wanted to say it right at the start. I would suggest that we actually rephrase the question of what we're talking about. Because we're saying is, can Nigeria fund itself without killing private sector? And I think what is more pertinent is to say, how can Nigeria fund itself without killing private sector? Now, why is that important? I must admit, I've noticed a certain tone to a lot of the questioning and a lot of the responses. And it takes a very them and us approach to building Nigeria. Who does Nigeria belong to? It belongs to every single one of us. It does not belong to just the government. And if governments, past or present, have in any way been behaving as if Nigeria belongs to just the government, well, then we as citizens should make it clear that Nigeria belongs to all of us. And if we're to build the Nigeria that we all desire to see, I put it to you that we will all have to work together collaboratively. Government will have to take certain responsibility, citizens will have to take certain responsibilities, NGOs, etc., etc. We all have to work together to build the Nigeria we desire to see. We can't keep saying government did this, they didn't do that, etc., etc. But then let me take it a step further. We're talking about government must show us they're doing things transparently. Government must, say what they're selling. When I asked the previous question, answered the previous question, I made it very clear that one, there was an asset register on the MOFI's website, and it behoves all of us to go onto the MOFI's website and say, what are these assets that we as Nigerians, it doesn't belong to government. It belongs to we as Nigerians. What do we owe? I also made the point that it is being categorized. It's not a one-size-fits-all approach to all the assets. It's being looked at and say, what's the best way to optimize it? But again, we as citizens, because I am first a citizen, first a Nigerian, before a government, a public servant. I am a public servant for a short period of time, but I will always be a Nigerian, and that responsibility comes first. And so we need to hold government responsible and say, government, with these assets, I see we have X, Y, and Z. What is your strategy regarding this? And then rather than, and then also where we have suggestions, constructively engage to say, have you considered this? Have you looked at that? Mr. Chukwu mentioned about NLNG. Of course, different conversations have had about different assets, but you're absolutely right. There is a recognition that you do not slaughter the golden egg. So one should not assume that government is always seeking to do what is the most wrong of things. Then he also spoke about roads, etc., etc. Thank you very much, Mr. Chukwu. That speaks to the Highway Development and Maintenance Initiative, HDMI, which has, in the first instance, there are 10 roads that we're working on. Even just yesterday, somebody sent me a video about the Benin-Asaba. So I encourage everybody, check out what's happening, for example, with the Benin-Asaba. So there's that recognition. So from the government's approach, borrowing is not the first port of call. Firstly, it's driving revenues, but driving up revenues in a responsible manner, driving up revenues in a manner that does not negatively impact economic growth in the medium to long term. So even when we're talking about, the Tax Act, etc., there's that recognition that the implementation of the Tax Act has got to be in a manner that balances both the fiscal and the economic imperatives of driving a growing and a sustainable economy. What else did I want to say? We're talking about, the different ways of selling assets. We spoke about what was done with telecoms, but we also know what happened with power. And I think we're all very much grown-ups in this room. We've all seen some things work. We've all seen some things fail. And what I would like to see is greater collaboration between government and the private sector, coming up with the answers that will work for Nigeria. On that note, I will go to the question that you asked me, AGOA. As you know, over the last few years, in terms of our export to the US, it's been roughly between $5 and $6 billion a year, but close to 90% of that has been in the oil and gas. It's been oil and gas products, so not something that benefits from AGOA. So yes, AGOA, of course, you know, one is not minimizing it, but it's not something that we as Nigeria has benefited from, you know, deeply over the last few years. Having said that, I'm sure you're aware, because Minister Oduwole speaks a lot about this. What we're trying to do is, one, we know that we've managed to improve the diversification of our economy. So it's not as dependent on oil as it needs to be, but also in terms of our exports, we are looking to grow non-oil exports. So I think at this point, I have spoken more than my fair share, and I'm sure that some of my co-panelists want to come after me, but believe me, you come after me, I'm coming back after you. But thank you for this very constructive and engaging conversation.
Yeah, thank you very much, Mrs. Okoli. You know, it's all about us. It's Nigeria. We're all Nigerians. So just like we are concerned about government holding them to account, government also has a responsibility to engage and provide insights into what's happening. Just like you've talked about the National Asset Register, just going through the website, there will still be questions around the process and the transparency, which is very important, going by the past experiences. And of course, you call for collaboration, and you've said that, yeah, this government is really committed. But of course, like we already said, it's a constructive conversation, and we'll continue in that regard. I don't know if Mr. Oyedeji has joined. If not, we'll just proceed with Mr. Johnson Chukwu. Of course, Mr. Okoli seems to agree with some of the things that Mr. Johnson Chukwu has raised about the concessioning, and you mentioned the highway development plan. But Mr. Chukwu, in the next few days, we're not going to go to monetary policy part. In the next few days, the Central Bank of Nigeria will hold its first monetary policy committee meeting for 2026. What are the expectations, especially in restoring policy transmissions among monetary policy dynamics, the markets, and the real sector?
Okay, my take is that the Monetary Policy Committee will at this point consider loosening, even if you're going to shave off 100 basis points from the MPR. Like we already said, that MPR is no longer aligned with current interest rate environment today. The last treasury-based 364-day instruments was, I think, about 16.3 or so percent. Compared to about 27% of MPR. So I think it's necessary that the Monetary Policy Committee align the Monetary Policy Committee so you can remain a benchmark rate. As it stands today, there's completely, if you use the MPR, it's almost a useless tool for any decision-making process because it's no longer aligned in any way with interest rate environment. But so I think they should reduce interest rate to align with current interest rate environment. But most importantly, the interest rate policy should be so that it's used to drive the economy in the direction the government wants it to grow. And I give you a couple of contradictions we're currently witnessing today in the economy, the macroeconomic environment. We've seen exchange rate appreciate to below 1,400. Government budget for this year is about 1,400 or 450 naira to $1. We are almost approaching 1,300. So the question you ask yourself, should we allow the exchange rate to continue to moderate? Bear in mind that the balance of payment, positive balance of trade we are witnessing is partly because of weak naira. So if you allow the exchange rate to continue to appreciate to a certain level, you are going to see a reversal of the current positive balance of trade because imports will increase when import becomes cheaper. And then you would completely erode whatever gain we've made in terms of stabilizing the our external factors, external factors, growing the reserve from a creation coming from surplus trade balance. That's one factor so to do that, it then means that the central bank has to either come to the market and begin to buy dollar or reduce interest rate to reduce the incentive that foreign portfolio investors have to just continue to accumulate local currency instruments. Some people may think it's contradictory because they think we want a stronger naira, but a stronger naira has its implications. And the question is the monetary authority willing to deal with those implications on a longer term basis? And that factor we're witnessing today is that as Naira is appreciating, because government has actually allowed for free importation of food, the cost of importing food is actually below the farm cost of food, locally produced food items, which will weaken local food production. These are some things that the economic managers should be conscious of. And that if that continues, you're going to kind of reduce the level of food we're currently producing and now reverse the almost achievement self-sufficiency in food production we've almost achieved prior to the high inflation rate we witnessed. And that factor that the Monetary Policy Committee has to consider is that we've seen a consistent decline in interest rate, in inflation rate. Last January figure was about 15.1%. So that gives you some level of comfort. And I do not think we should just focus on achieving single-digit interest rate. We should focus more on how do we grow economic activities. Bear in mind that the strongest way to keep inflation rate low is through increase in productivity. There's just a limit to what you can use monetary policy tools to deal with when you talk of growing productivity. The growth we need in productivity is a lower interest rate environment, stable inflation rate, low inflation rate, and higher level of productivity. Those will not be achieved. You can only achieve one of them, which is you are driving down inflation rate, but are you driving up productive activities? We are not doing that because the high interest rate environment is incentivizing private sector investors to stay in risk-free assets and therefore shy away from investing in risky assets, which is necessary for economic growth, which is necessary for productivity. And without productivity, you are not going to achieve the primary objective of improving the standard of living of Nigerians. It's that productivity that leads to higher income, like the income that is not driven by devaluation of local currency, real income growth, and that's what we need. So I think, in summary, the Monetary Policy Committee need to adjust significantly the current monetary policy rate. Ghana is a living successful example. We've seen Ghana in the past 6 months or thereabout. They have dropped their benchmark rate, and inflation has continued to moderate because productivity is increasing. So focus should be, what do we need to stimulate productive activities that will lead to a production of higher volume of goods and services that will ultimately lead to a more stable inflation rate environment. I think that's what I expect the Monetary Policy Committee to do at the next meeting.
Thank you very much, Mr. Johnson Chukwu. The expectation is that the Monetary Policy Authority should look at loosening the monetary policy rate, but targets what will stimulate productivity in our economy. Thank you very much, Mr. Johnson Chukwu. We now use for Dr. Ayoteriba to make his inputs. Doctor, yes, we're just walking around our time schedule, so apologies that we didn't call you on board initially. So
no problem.
Doctor,
you have called me now.
Doc, why are you shaking your head, eh?
You should have called me to respond to those 3 comments, not 6. Okay. But never mind. Okay, I'll respond to. I'll make 3 points.
Okay, Doctor.
And the 3 points are as follows. I'll join the point that Prof eloquently made about this disconnect between monetary policy rate and market rates. And what Chairman Chukwu just said about what we should be aiming for with regard to the exchange rate. Yeah, so the 2 relate to monetary policy. That's my first point. My second point is the point that Prof also eloquently made about what has been described in the media as asset sales. And I love Mrs. Okoli to kindly respond to what Prof said what assets make up that 189 billion. And I link it to what Mr. Chukwu has also said about assets, what Mrs. Okoli said about Mofi, and what Tilly said about concession, etc. So maybe I should start from asset sale and end up with the monetary policy. I think that's my preference. 289 billion. Sale of what? Sale of licenses that Mr. Chukwu eloquently commended. We sold GSM licenses through open bid. The licenses are assets. They are rights, but they are intangible assets. So we didn't, the license can expire. Is that what we are doing? Then it's commendable. But if it's not sale of intangible assets, we do licensing around all the time. How much do we make? How much hits the budget? If that's not it, let's be specific about assets. When we say go to the MOFI register, I was on the MOFI restructuring committee. We advocated, I wrote the memo to the president on national asset register. And I was on the governing committee of MOFI at inception 3 years ago. MOFI is 3 years old on the 2nd of February this year. I did not expect that after 3 years, we'll still be talking about asset register. It's like you telling me, that we should take census of all the cows in the country, of all the sheep, of all the goats, of all the chicken. It's like telling me census of Nigerians. It's of no use, it's of limited use. What matters is how many births are happening, how many deaths are occurring. And for livestock, it's how much gets to the abattoir. That's what's getting to GDP. So asset register without a deal room is dead. We can't spend 3 years still talking about asset register. And by the way, when we talk about assets, there are corporate assets, there are real estate, there are even land and build structure, and there are infrastructure. You treat them differently. You don't concession corporate assets. So transfer the corporate assets to 5% IPO, 20% IPO. So they have market value. You have NNPC, you have LNG, 49% of it. Their impact on Nigeria's balance sheet is nil. Well, they will borrow debt and give to NNPC. So go and list NNPC. Let's know the market value. So it shows on our balance sheet. And then it borrows in its own name. Not that we'll be borrowing government money and giving to companies that could borrow in their own name. And then for real estate, land, if you want to sell land, but build structure. Do you want to go and sell Federal Secretariat? And please, Mr. Chukwu, don't refer to our refineries as dead assets. So if you want to do refineries like you did LNG, don't take Chinese investors behind closed door to go and inspect. Do a bid like we did for the GSM companies. Let Chinese come. Let Saudi Arabians come. Let Brazilians come. Let them bid. And let's give that thing to and let's do joint venture like the MD of NNPC say. And then for either infrastructure, whether you are talking of terminals, let's repeat LNG model. You don't concession profitable infrastructure. And Mr. Chukwu was trying to articulate value capture. Infrastructure plus real estate. We should do JV, we should incorporate new companies and make money from our assets. Back to interest rates on closing. I'll close now on the interest rates and what Mr. Chukwu said. Central Bank Monetary Policy Committee is disconnected from reality. Because you set MPR at 27%. But the Department of the Central Bank does open market operation. Government issues at 17.5%. You buy, you sell. Huh? You buy, you sell at market rates. So your MPR does not influence the market influences you. So if MPR is different from market rate by more than 0.5%, it's a disconnect. MPR is an overnight rate. Institutional investors or portfolio investors don't invest in MPR. It's only banks that can buy. It's not the dated instrument. It's an overnight rate, so drop it. Go and check any other country. Once the policy rate diverges from the market rate, where the central bank itself trades, households trade in the treasury bill market, banks, companies, then you are disconnected. You're not controlling the market is controlling you. And please, Mr. Chukwu, the view you can canvass about exchange rates, if food price is below, imported food price is below market price, let's pursue strengthening the exchange rate until tractor price, imported tractor price also falls for the farmers. The fertilizer price should fall, raw materials and machinery and motor vehicles. Let the exchange rate. Naira is undervalued. Don't say that we should do anything to stop the valuation. So let's what eroded the welfare of Nigerians more than any other variable is the devaluation. From 700, let's even use the prime market in 2023 to 1,900, and it's now dropping to 1,300. Let it drop back to 700 for crying out. So the view you have canvassed, you are emphasizing the trade transition above the financial transition. Learn from from Britain. They exited the euro. They didn't join the euro because they don't want to strengthen production. And what can we produce and export that we want to use devaluation? We need liquidity. So the reason why the Naira is strengthening is net reserves has now risen to 30 or is even above 30. And exchange rates are strengthened and will strengthen for the rest of the year. Inflation is dropping and it will drop. Interest rate will drop in another quarter. Both inflation and interest rate should be single, and they should so remain. Everybody needs that. So what will improve productivity is cheap access to liquidity, whether from stock market or bond market or banks. Let's be borrowing at a single digit as we did in 2006, 2007. It's good for productivity, it's good for everybody. And the GDP of Nigeria will once again surge to the first in Africa the way it did after the 2007, 2008. Please don't canvass that view. Nigeria does not have the infrastructure, they don't have the energy, they don't have the transport to take advantage of cheap exchange rate. But if we have cheap liquidity that strong exchange rate can give us, you will repeat the experience of 2005 to 2015 in terms of expansion of the economy. Banks will be begging people in Okoli, begging people in a computer village to come and take credit at single digit. So please, let the central bank connect with market reality and let's allow exchange rate to be correctly valued. Right now, it is still undervalued. And the way to do it is to keep having the reserve adequacy that we lacked and throw the economy into tailspin until the correction of the foreign exchange market, willing buyer, willing seller, brought this correction, and let's see this correction to its logical conclusion. Thank you.
Thank you. Thank you. you very much, Doctor. Very elaborate response and input made in this very interesting conversation today. And the most important thing is, like you said, we need to see that transparency move from asset register to real deals. And we hope to see that begin to happen. So for the final phase of our conversations, we would, but before that, I just want to confirm if Dr. Tilewa is still available.
Can't you see me on the screen?
Okay, yes. So 2 minutes, just 2 minutes input before we wrap up the final phase of our conversation, Dr. Tilewa.
I'm actually going to wrap up now because I have to go back to a meeting. Yes. Well, first of all, let me thank all the speakers for their contribution. I want to touch on what Sanyade said. And I think it is important that we dialogue with government. I mean, maybe for me, in terms of my own advocacy, I always access people and ask their opinion and engage them. But I think what government also has to realize, Sanyade, is the fact that you guys are doing a terrible job in transmitting even your successes. And I think that it is important that, you know, since you are working at the level of the coordinating minister of the economy, I think it's important that we have that dialogue. It's not just MPC that we must have a formal dialogue after MPC, the central bank governor comes out and says something. It is important that the coordinating minister of the economy also come out and engage. You know, if every quarter, these are the quarterly updates, this is what's going on. Engage and dialogue. And of course, I engage you. If I need something, I call this person, call XY, call Z, what's going on, and it's different. And yes, is that trust deficit I think people are concerned about. But I think that trust deficit, again, has now led to a lot of complacency because some people do not want to follow the process of any privatization or any government process. You've already killed it with your negativity and the fact that are they serious? Are they going to sell it to their friends? But sometimes, you know, you follow a process. At the end of the day, you realize you are the only person left there. So I think that engagement between the public sector and the private sector, and I think the coordinating minister of the economy side, whereby giving us a full view, because all the MPC does is give us monetary. So I think the coordinating minister of the economy needs to engage more on a quarterly basis and give us the full view of the economy, both monetary policy, fiscal policy, investment, trade, and industrial policy. So we have a full view of the process. So in closing, all I'm going to say is the fact that the potential of the Nigerian economy is there. We need to manage it properly. The gains of these last 2 years, the government needs to be able to promote that. And of course, the challenge now is to come up with your disinflation and growth strategies for productivity. I think, as Mr. Chukwu has said, the key now is creating productivity, employment that will grow the economy at about 8 to 10%. So those are the strategies that I see that you need to project going forward. Continue with these programs. They're there, they're transparent. But like I said, you guys need to come out and let people know better what you're doing. The reforms, as you see, the results of those reforms are there. But as we've said, there is need for you to connect properly with the public on this issue. Now, my final note is on this taxation. The Nigerian Revenue Service has increased the taxes of Nigerians with these new tax laws. The tax projections for this year is going to be 40% higher collections than they did last year. So what that means clearly is the fact that we have a tax increase, especially if our projected GDP is about 4.4%. Now, with all these increased taxes, the budget is failing because you've now budgeted a lot more, which is unrealistic, and now you have a deficit of 25 trillion. But you're raising taxes. You see, so you cannot continue to raise taxes and then basically begin to budget higher than what your revenues are. For me, this is the biggest disconnect. So we need a fiscal reset, and that's why I talk about the Fiscal Responsibility Act. So I think, yes, fantastic. Keep up the good job. It's been a fantastic conversation. But I think, like I've said, I think the moderator also has to try to measure your questions on a practical level, not just on a textbook, take a question out of a textbook. What is the practicality so that this audience can do justice to it, because the caliber of people you have here, we need to look at practical solutions. There are market operators here, there are intellectual people here, and more importantly, we have somebody from government, because she now has to be able to take back what we've discussed here to go back inside. And then we also need to put her in a position that next time she has something to say or something to do, she can also call on us and say, guys, you know, even in a closed group. So I think it's also important for her to have a closed group. That, okay, look, guys, this is what we're looking at. What is your feedback from there? So at least you get those 4 or 5 positions coming into to help you with decision making. But I think you guys need to do a better job of telegraphing your successes, because you've accomplished a lot. Nobody's going to blow your trumpet for you. On this note, I'd like to thank you for everybody, and I'm going to sign off.
Thank you very much, Dr. Tilewa Adebajo, CEO of the CFG Advisory. Thank you so much for the input of the need for fiscal resets, more engagement between the Coordinating Minister of Economy and, of course, stakeholders. And, of course, for us in Proshare, we're committed to constructive engagements and continue to make it pragmatic. Thank you very, very much for your input, Dr. Adebajo. So we'll go to the last phase of our conversation, and this is where we'd manage the allocated time, and hopefully our speakers can work within the time as we begin to wrap up. But for some of the speakers, we would be integrating some questions that have come online. Mrs. Sanyade Okoli will respond to one of the questions, and of course, we'll take Mr. Johnson Chukwu to take one of the other questions. So we'll begin with Professor Obafemi. In 2 minutes, if you could mandate a policy priority that would fundamentally alter Nigeria's debt growth ratio based on where we are now, what would it be, and why would it be the most powerful lever for change? In 2 minutes.
Yeah, thanks so much. And as usual, as I said before, I thank all the contributors. I'm learning and I'm learning. By the time I will go back to the classroom, my head will be filled with practical things for my postgraduate students. Thank you so much. Yeah.
Okay, Prof, it's like Prof has a slight glitch, but I think we'll come back to her. Let's just move quickly to Mrs. Okoli. So Mrs. Okoli, we have a question, but also we'll integrate it with a question from the platform. So the first question is, the $1 trillion...
Our problem is not monetary policy, because as it is now, monetary policy is not even effective, as other speakers have spoken. Our fiscal priority for now has to deal with the fiscal. Okay, sorry, I was cut off by the network.
Okay, Prof, you can continue. Yeah.
So we can't stop talking about increased productivity. So we should borrow. Let our borrowing be that, yeah, let our be project specific in such a way that we could even monitor the productivity of the projects. I had given an example of Sukuk. Sukuk is doing well. For those of us that go across Nigeria, you know how Sukuk is doing well. Can we repeat that kind of thing in our borrowing? And borrow for things we can monitor their productivity. And of course, like we have already said, let the Fiscal Responsibility Act, let that act be made effective. So I think that Nigeria we should work on our fiscal structure, because the monetary policy is overshadowed by the fiscal dominance as we are having now. So if we could do that and work on our fiscal structure, borrow for productivity's sake, borrow to encourage things that are growth-inducing or enhancing issues, I think we'll be better off for it. Let our borrowing be targeted. There are countries that do that, and let the law cover it. Thank you.
Thank you, Prof. Mrs.
Yeah,
Okoli,
thank you. I'm done.
We have, yeah. Mrs. Okoli, we'll integrate one question from the audience with the question we're going to ask you. The $1 trillion economy target of the current administration requires massive private investments Amidst the high rates environment and relative FX stability, what investment playbook is the government presenting to global investors and fund managers? Ample opportunities or partnership frameworks to convince investors that Nigeria's risk-adjusted return is compelling? That's the first question. And then the question from the platform, the second question is, how is Nigeria ensuring that heavy borrowing doesn't crowd out private investment? And what signs should investors watch for if the balance fails? So that's the second question integrated. And we'll give you 3 minutes to respond to this.
Okay, thank you. Taking the second question first, to be honest, I'm not sure how that is different from the first question I answered. So I'm not going to major on that one. I think just quickly summarizing what I've heard there, in this conversation, there are a few things I think we've all agreed on. One, debt sustainability is key. Two, we have to ensure that we're optimizing our assets. Three, sustainable growth is non-negotiable. Four, of course, we have to increase our productivity. So Chukwu spoke about, somebody spoke about agriculture. We have to increase our agricultural productivity. We need to improve electricity to ensure that productivity generally increases. But one thing, without saying so, I think we all actually agree on, is that economic management is complex. I think by the very nature of the divergence of views that we have heard so far, it's a reminder that it's not always so simple. If you just do A, B will happen, and C. There are complexities. And that leads me to a point that Dr. Adebayo made, which is about greater engagement. I'll be the first to admit that we as a government have not always been good with our communication and engagement. I'm hoping that over the last, certainly in 2025, you saw a marked improvement, and we will continue to improve. And funnily enough, I wish he was on. Just yesterday, I was on a call with some development partners and working on how we can actually start having these quarterly engagements. So we recognize that there's a lot more to be done, and we will keep pushing on that. Now, specifically to the $1 trillion economy, honestly, it goes back to my previous point. It's not just about government. When you look about a $1 trillion economy, investment, it can only be driven by investment. But the proportion of that investment that will be coming from federal government, you've got federal government, you've got subnationals, you've got the private sector, and the lion's share has to come from the private sector. Therefore, I think the two critical roles government can play. One is to make the economy more attractive to investors. And that's, the 4 pillars that we're working on. Continued pursuit of macroeconomic stability. Because without that stability, you're not going to attract investors. Between Mr. Chukwu and Dr. Teriba, there's a question of what should we be doing with our FX rate? Should CBN intervene? Should CBN not intervene? That again speaks to the complexity. But I think what investors want to do, they want to see stability, they want to see predictability, they want to see the inflation rates to keep coming down, etc. Two, you need essentially your policy frameworks, the governance, the regulation. Again, you need stability and predictability. At various levels and in various ways, government will working on that. The third piece is infrastructure. Infrastructure. We've spoken about roads. There's work we're doing on the electricity side. There's the digital, that like the 90,000 kilometer fiber we're putting digital infrastructure. And the last, and I think that relates to really the topic of what you're doing, is improving access to finance, both from the central bank standpoint in terms of, the rule book to enable banks to lend more easily, especially to SMEs, but also the Securities and Exchange Commission. We know they have the new ISA that they're implementing. So really, in a nutshell, if we want to see that the economic growth, government focus on make the economy attractive, but then also ensure that where government is spending, and I think that's what a lot of people have been saying, and we agree, ensure our spend is catalytic. Ensure we're spending in areas that would really move the needle for the economy. And that in itself, if you're asking about the playbook, that's the broad playbook. It's not just about trying to bring government money into government deals, because that alone is not going to give us the growth and activity we desire. Thank you. I think we might have lost Otto. So, Mr. Chukwu, I'd say over to you. With that, Otto, you can answer whatever question you want to answer.
I guess Femi will be on the phone on the call, so maybe he also has access to the questions on the platform. I guess we should be able to see the question and answer session. Okay, let me go to the question and answer thing that we should. Okay, maybe
You're muted, Otto. You're muted, Otto.
Maybe while we are expecting him to join back, I will take the question that's on the platform. He said, I should think that what we all should, I think that's Bade Joko and Odufote. He said, I think what we all should be interested in is the interest rate that will enable the private sector to borrow with
Can you hear me now, Mr. Johnson Chukwu?
Yes, we can hear you now.
Okay, so yes, sorry for that slight glitch. So it's just integrating two questions, and we trust you can do that in 2 minutes. What is the non-negotiable signal for restoring investor confidence in Nigeria? Is it a specific inflation target and FX rate target? Or, of course, like we look at a debt to GDP target at this time, or debt to revenue cap, sorry. And then what other policies and outcomes will make you confidently tell our global investors that Nigeria's 2030 story is a buy now? And Mr. Chukwu, we know you interact a lot with global investors. Then the second question is, of course, still around borrowing strategy. How sustainable is Nigeria's borrowing strategy in the next 3 to 5 years, especially if global interest rates rise or revenue targets are missed? And what contingency plans exist to protect private sector growth in such scenario? Speaking from a private sector perspective, Mr. Chukwu.
Okay, let me start from the first part of your question. What investors would look out for, foreign investors look out for, particularly long-term investors, is that FX stability. When we talk of FX stability, we're talking of rate stability. But most importantly, liquidity within the FX market. They want to be able to come into your economy and live where they want to live. So we have reasonably liberalized the FX market. We've achieved some level of liquidity and a reasonable level of liquidity, and we have seen the currency appreciate. Though that's a different, the level of appreciation is a subject of a different conversation. So foreign investors are looking out for that. But what is now lacking is that productivity. They're looking at your GDP growth rate. They are looking at sectorial performances of the economy. They are looking at which sectors should I come in, which is why we are not yet seeing foreign direct investment. We are seeing a very preponderance of foreign portfolio investment. If you look at the 3 quarters of last year, that's the first 9 months of last year, total capital importation in the country was about 16.777 trillion and $16.78 billion, $16.78 billion. Of that amount, only $565 million was foreign direct investment. Just about 3% of the total capital importation to the country was foreign direct investment. So we are not yet seeing that. And they are looking for government direction. The government direction will come. Which sectors is the government focusing on? What are the fiscal incentives that have been implemented or are available for investors to come into that sector? So I think the outlook is that in the short term, our macroeconomic environment look attractive. We are seeing a lot of foreign capital importation from foreign portfolio investors, particularly debt instrument investors, money market and other debt instruments. The other thing we have to ask is that What are those things that will make us comfortable or will make one say, look, the $1 trillion economy in 2030 is feasible? I think it's an aspirational projection of the government. Aspiration, I repeat the word aspirational. The reality that we'll achieve $1 trillion in 2050 is not even there if we continue to grow the economy at the rate we are growing today. And that is why the emphasis should be productivity, productivity, productivity. How do we tweak our economic environment that would be a low-cost producer, which means we must have infrastructural support that will make it easy for us to produce locally at costs that are comparative to what is obtainable elsewhere in the world. We talked about AGOA, American AGOA, and we say we never benefited from it. The largest beneficiary, the biggest beneficiary in Africa was the likes of South Africa, the likes of Botswana, because they have efficient infrastructural supply that make it possible to produce efficiently and export to other countries. And that should be the focus of the government. And that is what will make our aspirational economic growth to be in some ways realistic or realizable. Even if it's not realizable in 2030, maybe realizable in 2050. And I think I will leave it at that. Thank you.
Thank you very much, Mr. Johnson Chukwu. We appreciate all speakers for a very interesting enlightening panel session. We are now reached the 2-hour mark for this conversation, and now we'll be going to wrap up so that, of course, we can move on to our other day's activity. So to all our esteemed speakers, I want to really appreciate you and thank you for making our time for this conversation. But yes, before we proceed, I would just like in the next 2 minutes, our Director of Research, Mr. Teslim Shitabe, to just make a short remark in 2 minutes. Thank you.
Thank you, Otto Abasi, Okay. Thank you very much. Thank you, everyone, for a very engaging session. Undoubtedly, the conversation has just started. The way the passion of Mr. Johnson Chukwu about some of these issues, Dr. Teriba with the intellectual insights that he gave us concerning monetary and fiscal policy, Mrs. Sanyade, Okoli, her passionate discussion about what government has been doing, what it intends to be, what it intends to do, and then Prof herself. The great insights she's given us have been collectively very informative, and I'm sure that the audience have had a feel of the kind of conversations that will continue to be held on the Proshare platform for the purposes of engaging everybody. Mrs. Sanyade talked about something, Mrs. Okoli talked about something. Nigeria is for everybody. It isn't for the public sector or the private sector, it's for every single one of us. And therefore, engaging these conversations, I believe, is the right way to go towards evolving a society that is beneficial to every single person within it. I want to thank everybody who are on this call, the participants, the discussants. Mrs. Sanyade, thank you very much for your perspectives. I think they're very timely. It's kind of what Dr. Tiliwa talked about. We need regular government interface, regular government engagement, so we have a clearer understanding and we can reduce the trust deficit that we currently experience in the public space. Mr. Johnson Chukwu, our great friend, I didn't expect anything less. Thank you very much for your contributions. Also, Abasi, and of course, yes, let me talk about the chairman of Proshare, who has been a very ardent advocate for these kinds of public engagement, for us to be able to push the plate forward, for us to engage in such a manner that is not adversarial, but it basically shows that there are many sides to the story. We need to understand where the other person is coming from so that we can have a more holistic solution to the Nigerian challenge. It's not a problem, it's a challenge. I think we're all up to that challenge. Mrs. Sanyade really pointed it out very clearly. Madam, we're in support of your government. We're in support of your arguments. And this, the whole essence actually is what I saw today. Conversation, engagement. Like you pointed out correctly, the issues are complex, but we're tougher than the complexity of the issues we have seen. So thank you very much, everybody. Otto Abasiekong, that's why I kept mute. I was so engaged in listening to everybody. I just decided that, you know what? This is about listening, not about talking. Thank you very much, everyone who was in attendance. Ladies and gentlemen of the media, the press, other people who joined this event, I thank you very much. Otto, over to you. I'm a man of few words. Otto. Hello, Otto.
I think it's Slim. Otto has handed over to you.
Oh, Otto.
Yes,
okay, he's back.
Thank you very much. Thank you very much, Mr. Taslim Shitabe, Director of Research, Proshare, for your inputs. And of course, we'll continue to have these engagements because it's for the greater benefits of our country. And of course, inclusive economy is what we push for. So I want to thank all our participants and for the patience, participation, and engagement through our polls, and of course, listening. There's a lot that you've learned from today. I must commend the Proshare team for ensuring a very seamless and interesting conference webinar. We enjoin you to log on to our website and follow our social media platforms to get more economic insights and market intelligence. So I want to just thank our esteemed panelists that featured today, Mrs. Sanyade Okoli, the Special Advisor to the President on Finance and Economy. Thank you, Ma, for taking out time for this conversation. I want to thank Mr. Johnson Chukwu, Group Chief Executive Officer of Cowry Asset Management, for being a part of this conversation. I also want to thank Professor Francis Obafemi, an economist, and the Department of Economics, University of Calabar. It was nice to have a scholar give our perspective. And of course, our guest appearance, I want to thank Dr. Ayo Teriba, CEO of Economic Associates, and Dr. Telewa Adebajo, CEO, the CFG Advisory, for making the guest appearance and deepening and broadening our conversation. Thank you very much. And before we wrap up, I would like us to have a group photo up. If you can all put out our video up so that we can take a photo up just to wrap up this conversation. Thank you very much. Thank you for the patience, and I believe it has been a very interesting conversation. So I will join us, like I said earlier, to log on to our website and follow our social media platforms, including the latest one on View, the Leke. We are also on that platform. So I'd like you to follow us on the platform. Also, we'd like to inform you that Proshare, in partnership with Economic Associates, is coming out with a report. It's called Country Watch, Nigeria Economic Outlook. In the days to come, that report will be unveiled, and I would like you to follow us. Log on to our website, follow our social media platforms for what promises to be a very deep, incisive report about our economic landscape. It's been a pleasure being part of this conversation, anchoring it, and of course, a lot to take away and unpack. And till our next edition of the Proshare Economist Conference webinar, I'm Otto Abasiekong. Thank you for being a part of this webinar, and have a great day.
Thank you, everyone.